Welcome. Thanks for joining us. I'm really excited about this topic here with Denise Baver, one of my favorite IBC people. And Denise, you're going to talk about a really cool idea and an option for people that's out there that many may not be aware of, called a premium deposit fund. Really interested to dive into this with you for our visitors and anybody looking at high cash value whole life for the first time. And so, Denise, let's jump in. What's a premium deposit fund?
So this is a really good solution for a lot of people. So a premium deposit fund is basically a savings account that sits alongside your whole life insurance for funding. So, for example, sometimes people have a lump sum of money they want to put in their policies, but sometimes that doesn't always make sense, because when you put in a lump sum, it increases the death benefit, because we always have to stay below what we call the MEC limit, right? Which is just,
Right.
There's restrictions of how much money can go into a specific death benefit. So human nature, I call it a protection from human nature, because a lot of times if we have a lump sum of money that we have great intentions to put it into our policy, but if it can't go in all in 1 year and it stays in our checking account or a savings account, sometimes life happens and it doesn't end up to be where it's supposed to be. So this is a protection from that. And it also is, as far as what it earns when it's in this fund, it's beating. I was on bankrate.com and the interest rates are much higher in a premium deposit fund. It's the same thing. It's a taxable account, but it's a savings account. And I'll go over the details of that, but that's basically what it is. It's kind of a holding tank for money to get put into your policy. People like the idea of let's set it and forget it. Who likes to think about, oh, I have to do this every year? What if it was automatic and you didn't need to think about it?
Great. So that's exciting. So let me stop you for a second. So what we're talking about is that if people are putting, say, maybe an annual premium into a policy and they want to set it aside, right, in an account that's going to be more favorable for them than just a traditional bank account, and it's not going to be muddled with their other assets. That might be one reason, correct?
Yes.
And maybe another reason is if people are doing a couple of lump sums, right? So if someone wants to do like an initial lump sum followed by some larger or medium-sized premiums, is that another? I'm just trying to get at a scenario maybe where someone would use this if they're kind of dialing in for the first time.
Yeah. So let's say they want to put $100,000 into their policy. But if we put $100,000 in year one, that could create a bigger premium to sustain going forward, right? Because the death benefit's going to be big. So we want to split it into 4 years. We want to put $25,000 in for the next 4 years. They put the $100,000 in the premium deposit and forget about it for the next 4 years, because that deposit is going to automatically fund their policy annually.
I got it. So they actually make the deposit
once
into the.
Yeah.
Okay.
Yeah.
Once.
So that money is dispersed over those 4 years or 5 years or 6 years. You can go as long as you want. Whatever plan is appropriate for whatever you're trying to do, whatever your goals are.
So the company itself setting up the premium deposit fund then pays the premiums out of that account.
Correct.
Cool. Well, I know you have some examples here, and I think people might want to be interested in seeing this. So let's take a look here.
Yeah. So I'm a visual learner. I love visualizations. That's why I kind of picked this little slide. I'm not focusing on any one particular company. Most companies have premium and deposit funds. This is just an example that I really liked. So basically, to put it in really simple terms, you as the policy owner, this little blue guy down here, is actually just putting a lump sum into that premium deposit fund, where it's going to hold that and it's going to earn interest. And the exciting thing about this is that currently that interest rate is 3%. But in January, it is going up to 5% with this particular company. So that is huge. Like I said, I went on Bankrate, and the highest rates I could find anywhere in either high yield savings accounts, CDs, whatever, was like 3.6.
Boom. So
So
Denise, so
mhm,
we're in a climate of rising interest rates, right?
correct.
And of course, many are upset about this, but in the world of high cash value whole life, it actually creates some advantages, right? And this is a good example. It can also affect dividend rates, which is another webinar down the road,
Mhm.
positively. But you're saying that for these premium deposit accounts or funds, the rates are going up, which is great.
Yes, yes. And they're traditionally higher than bank rates. Um, just like a whole life policy, the gains are traditionally better than a bank rate.
5%, is that locked in then, or how do they do that?
So it's fine. Yes. So it's locked in.
Okay.
Yep. So it'd be 5%. And I'm going to show you an example of what that looks like. It's the example I show you is going to be 3% because it's not 5% yet, but it's going to be, the numbers will just be a little bit different. But, the advantages of the premium deposit fund are kind of things that I already just said. There is a favorable, you want to maintain the favorable tax treatment, which is the MEC limit I mentioned. So you obviously don't want to go over that and have your gains taxed. You're prepaying your future premiums on a discounted basis only because your interest that you're earning in your premium deposit fund is actually going into your whole life policy. And I'll show you an example of that in a second. And I love the peace of mind part because it's true. It's like, if you've already got to put it there. And one really cool feature about the peace of mind is that if you put it in the premium deposit fund and next year you say, something, I really need this money, I really have to take it out. It's liquid. It's 100% liquid, just like a savings account. There is no penalty to take it out. The only thing that if you withdraw, you have to withdraw the whole balance. You can't just take a partial withdrawal.
Okay.
But that's kind of comforting knowing, all right, I can put it in here. This is my intention, right? Sometimes our intentions don't always happen.
Right, so
but always have that safety net of being able to pull it out if you needed to.
So you can pull it out, and it's got similar flexibility to really with some of the whole life products that are out there. People think they're not flexible. Actually, there is flexibility. Let's say something changes, they have to pull it out. Maybe they do a reduce paid up, like in the following year, if that's available, depending on the company. So there is flexibility that people can consider as they're going through this, correct?
Right. And, one thing about whole life is that is the most flexible vehicle on the planet as far as premium payments and whatever. Even in this example, if you say, your intention was to put 100,000, 25,000 in the next 4 years, and then something happens, you don't have to put 25,000 in your policy every year. You can put the minimum in if you want. And then year 3, you could put 25,000 in. Once it's built to hold it, it's built to hold it.
But that's a huge misnomer, isn't it? People
I know.
don't think that the flexibility is there, and it's actually a safe kind of flexibility that's very valuable, I would think.
Yes.
Great.
This conversation has my mind going in all these different directions about flexibility and, all right, what happens if I lose my job and I can't pay my premium? It's like, guess what? If you've been overfunding your policy is good. By not putting anything into it, you've got safety there. Maybe that'll be another seminar.
I think that's another webinar, but this is exciting. So basically, premium deposit fund, 5%, which is great in a protected setting, funding a high cash value policy. So definitely an option for folks to consider. Anything else you'd like to throw out there as we're wrapping up?
Yeah, I do. I just want to kind of show what actually happens when you put your money into this account. Okay. So basically we have that $100,000.
Hang on, Denise. So I'll edit that out. So go ahead, because I didn't realize that you're still doing this. So
well, that's okay. No, because it's a kind of segue into wrapping it out.
Okay, so go ahead and just kind of start from your original thought there again.
Yeah. So I just want to show you an example of what actually happens when you put this money in this account. So this is $100,000 that's going in year 1. Your premium, you would think, all right, I'm putting 100,000 over 4 years. My premium going into the policy is 25,000, but it's not, because it's including the interest. So you're actually getting more for your money. You're putting the 26,119 in first year. So your balance is 73. And the next year they're going to credit your interest. So you're starting out at 76. They're going to pay a premium and then it just goes for the 4 years. And at the end of 4 years, you're pretty much done. But over the 4 years, and this again is at 3%, and in January, we're looking at 5%, but you would have earned $4,400 on that money that's waiting to go into your whole life policy.
Very cool. So Denise, why do you use 4 years? I noticed some people are going to probably say 7, depending on, the MEC. You're saying you can you can avoid the MEC in 4 years if you set it up.
So I'm not saying that at the end of 4 years, you're not going to pay a policy anymore.
Okay.
Because most people want to pay it longer. This is their bank.
Right.
They don't want to stop paying, but you could just pay the minimum after that, or you can continue throwing in 25,000.
Okay.
We're just using that lump sum and I'm just dividing it, and you could divide it over 7. And sometimes I do that if sometimes people have a lump sum of money and they say, this is what I want to put into my policy. And that's it. And that may be $400,000 or $500,000. And then we will put it in over 7 years because they really don't want to use it before that, or they can anyhow, but we put it in. So then they don't have to make a payment after the 7th year.
Okay. So this could be 7. It could be whatever somebody
10,
decides.
It could be whatever. Yeah, whatever. I'm just using
Gotcha.
4 as an example because it was easy, to kind of comprehend 100,000 and the 25,000.
Breaking it up into 4. I gotcha.
Yeah.
So,
yeah.
And this is complementary to everything we often talk about with, where do you want to put your money, right? Traditional bank versus other options. And so this is a pretty exciting option for many reasons that you've been talking about. So.
Yeah, it is.
Okay. All right. So, I guess to kind of frame this before we jump off, what do I want to say here? Oh, okay. So this is exciting, Denise. So in other words, if people are thinking about lump sums, right, just to kind of recap, they have maybe an option. They can either consider a MEC, or if they want to avoid the MEC and have the life insurance, then this is an option because they can fund a policy, put the balance of of whatever they want to put into this account and be funding it over a period of years. Is that accurate?
Yes.
All right. So if you got lump sums, guys, this is one option. Rising interest rates make it even better. Any other thoughts, Denise?
No, but it's, a combination, to have this sit alongside your whole life policy and, protect your intentions is a good thing.
Absolutely. So if you want to learn more, guys, there's going to be a link wherever you're watching this webinar. You can set up a time to talk about it in detail. There are other webinars. We've got more content coming out. You can like and subscribe and join the movement. And Denise, thanks again, and looking forward to jumping into more future topics.
Awesome.
Thanks, guys.
Thank you.
All right.